Bell has been on a downtrend spiral over the last couple of years where we've seen its value tanks close to 30% year to date and over 40% over the past 5 years. So today we'll break down together this company that is currently offering over 10% of dividend to their shareholders to see whether or not it is a great pick or not at the moment. As always, after checking out what is their business model, so how are they able to generate their income and what are the most recent news, we'll make a quick fundamental analysis followed by a price prediction with different evaluation models to see what is the true intrinsic value of this company. Bell, with the ticker BCE, is a Canadian telecommunication company that has been founded in 1880 after the name of the famous telephone creator Alexander Graham Bell. Over the last couple of decades, we've seen that Bell has been able to establish themselves as a true top dog in the telecommunication market in Canada. What is pretty interesting about this market right here is that it is pretty much a triopoly divided between three big companies where we have first Bell, Rogers, and TELUS. Despite that, just like its competitors, Bell's total value has been plummeting over the last couple of months and years, reaching out about $30 billion of market cap at the moment. This unfortunate turn of event has been caused by many important factors, as we'll see later on, but first, let's examine together what are the most important parts of Bell business model. With no surprise, Bell is generating the largest part of their total earnings from their Bell Communication and Technology Services branch. Unfortunately, this branch that is mainly composed by their different computer, Wi-Fi, and phone products and services has been decreasing by about 14.3% year over year due to a $61 million decline attributed to the source closures and timing of transition to Best Buy Express, as well as a 25% decline in mobile phone contract sales. The only positive news is that since the company has been able to quite significantly decrease their total expenses over the last quarter compared to 2023, this has helped them to generate a slight increase in their total adjusted EBITDA year over year. On their side, their other branch is their Bell Media subsidiary, which is mainly composed by different television stations that are part of the CTV and Nouveau networks such as TSN, RDS, and Crave. This smaller branch of their business model has still been able to generate some phenomenal growth over the past quarter, where we've seen their total revenue grow by about 10% year over year. This was mainly driven by higher digital revenues, notably in terms of their digital advertising increase that are up 23% year over year. And this has made their total adjusted EBITDA for this segment increase by about 25% year over year. And so we can understand that it is this segment of their business model in the last quarter that have helped them to slightly increase their total adjusted EBITDA despite a slight decrease in their total revenue. Add to this, since last year, we've seen that Bell has started to significantly decrease their total capex because notably of the CRTC decision. This decision that was made at the end of 2023 was to broaden the access to the large telephone companies' 5 networks across Canada. Unfortunately for Bell, this type of measure has the impact to give more potential market shares to smaller competitors of them on the overall market by controlling the supply price. And so even if Bell over the past couple of decades has been tremendously working on trying to expand their network and most importantly their 5G networks across Canada, this decision has convinced them to stop investing as much as they did in the past. It is why in the last quarter of 2023 they've announced their intention to reduce their total capital investments by about $735 million in the 2024-2025 period, including a minimum of $367 million in 2024 to $3 billion versus the originally planned $3.6 billion. It is why, with that regard, we can see that in their latest earnings report, their total capital expenditure have been diminishing by about 17% year over year. From a profitability point of view, we can obviously see this as a great positive news since we can see that their total free cash flow have been increasing despite a slight diminution in their cash flow from the operations. And so, even if this news could seem pretty interesting for many investors, knowing the history of Bell to borrow a lot of money and to accumulate a lot of debt in the past to notably invest in expanding their network, and with the numerous hikes of the interest rate between 2022 and 2023, this has had a bunch of different downfall on the total value of the interest payments that Bell are paying. It is why this Canadian company has decided to cut on many of their important expenses. Obviously, you can understand that by cutting expenses, they won't only be cutting the different expenses linked to the expansion, but also different staffing expenses. It is why at the beginning of 2024, we've seen that Bell has been proceeding to one of its biggest layoffs over the past couple of decades, where they've cut over 4,000 jobs in their restructuring effort. But while this might help them to breathe a little bit more in this ton of debt that they need to pay back, this hasn't been seen with a good eye by many investors. And in fact, this is one of the main reasons why Bell's total value has been plummeting over the past year. Furthermore, at the moment, many investors might be attracted by the juicy 10% dividend that Bell is offering, but keep in mind that this might not be sustainable in the long term, knowing that the company is presently cutting a lot of their different expenses. The dividend could be next on this list. It is why at the moment we can see that the company has such a high payout ratio because they are not generating a lot of money compared to their total expenses. So the least we can say is that the news of Bell aren't really encouraging. However, the worst part in it, in my personal opinion, is about the management board of this company. Unfortunately for Bell shareholders, with their current CEO, Mirko Bibic, that has been in place since 2020, we can see that the stock has been tanking more than 40% over the past 5 years, while on its side, the stock market has been up by over 80% throughout that same period. Add to this, while the company has been struggling financially, we've seen the different directors and the board of managers giving themselves some big juicy bonuses. For example, for the last year, we've seen the CEO of Bell receiving an additional $3 million to its already strong compensation plan. In my opinion, it is totally unacceptable that the CEO and the directors are attributing themselves big bonuses despite poor results and a big wave of layoffs lately. And it is why it is super important for you to understand who are the different board of managers and the CEO of the company before to invest in any type of stocks. But to find if there's still hope concerning Bell, now let's take a look at what the different valuation metrics are telling us about the true value of this company. First, by taking a look at the evolution of the market cap of this company over the past 2 years, we can see that it has been significantly decreasing, where it went from about $47 billion to about $34 billion right now. But what is also pretty concerning for the investors is the evolution of their PE ratio that went from about 20 to over 422 right now. This would be showing that at the moment, Bell would currently be overvalued. In terms of the profitability of the company, we can see that it has been able to achieve some super poor profit margin of only 1% despite having some incredible operating margin over the past 12 months of close to 25%. But at the end of the day, we can see that for the investors, they have only been able to achieve over the last 12 months some return on equity of about 1.55%. Throughout that same period, we can see that they've been able to generate some revenue of about $24.46 billion, where in the last quarter, they've seen a slight decrease of about 1.80% in their total quarterly revenue growth. Another scary point for the investors of Bell is the fact that at the moment, the company only has about $2.61 billion of cash compared to a gigantic debt of over $40 billion. And in total, we can see that this debt currently represents over 222% of the total equity. In terms of the volatility of the company, so how does the company will fluctuate rate throughout time. As always, we'll be using the beta on a 5 years period, and with a beta of about 0.48 over the past 5 years, which would be indicating that Bell would fluctuate about 2 times less than the overall market throughout that same period. We can see that it has been doing pretty much the same total return compared to the market, but in reverse, where it has been returning about less 30% versus 30% of total gain for the overall market. In terms of the current dividend of Bell, that is close to $4 per share, or an average dividend yield of about 10.50%. As I mentioned earlier, this dividend is far from being sustainable in the long term, where we can see that our payout ratio is over 4,000%. But now, to determine what is the true intrinsic value of Bell, as always, we'll be using different valuation models, starting out with the Peter Lynch one, which is a simple formula where you add the future growth of the earnings per share with the dividend yield and that you divide with the price to earnings ratio. And so, even if the dividend yield is currently over 10.50%, we can find that with a negative future EPS growth that is predicted by the analyst over the next 5 years, combined with a super high price to earnings ratio of over 400, it would be showing that the stock at the moment would be massively overvalued. Then for the second model on this list, which is the dividend discounted model, unfortunately, since we can see that the average growth rate is bigger than our weighted average cost of capital, we won't be able to use it. Jumping out to the third model on this list, which is the discounted cash flow model, where we will discount all the future free cash flow of this company that are predicted for the next couple of years to see and find what is the true value of it. We first need to find what is the cost of debt, then the cost of equity, and after the cost of debt and equity to find our weighted average cost of capital. And with this WACC, we can find that the current intrinsic value of this company would be about $126 per share, meaning that it would currently be quite undervalued right now. Finally, the two last models on our list are the Graham's original value formula and the Graham's revised value formula. Unfortunately, in both cases, just like the dividend discounted model, this model won't work since we can see that our intrinsic value is in negative or at $0 per share. This is basically linked to the fact that our growth rate that is projected by the analyst for the next 5 years is negative. As you've been able to see in this video, with the different financial metrics and valuation models, we could currently see that Bell would be pretty much overvalued at the moment. Personally, I've lost a lot of trust towards this company over the past couple of years, where it has been performing tremendously bad while the stock market has been exploding in value. And even if the telecom market as a whole has been the worst performing market of the TS6 market over the last year, Bell on its side has been by far the worst company in it. Add to this, with the different traditional medias in Bell business model, we can see that they are losing a lot of ground to the younger generation that often prefer to go on different social medias. It is why, just like oil companies that need to adapt to tomorrow's environment by notably including different renewable energy projects to their business model, Bell on their side will definitely to adapt it notably to the younger generation. It is why I personally believe that there are way better places to invest your money at the moment, and it is notably why I've also sold a bunch of the different shares that I've held of this company. And so on your side, if you're looking for an excellent broker to start investing in Canada and the US, I have recently transferred a lot of my money towards Moomoo to benefit from all the great features that they are offering to their different customers. So if you want to see what are the different perks by investing with Moomoo, check out the link in the description of this video. And if you're looking for other great stocks to invest in before the end of 2024, check out the video that's going to be right over here, and I will see you soon. Peace.